Hey, what's up everyone, and welcome to the School of Personal Finance. So a few weeks ago I put out a video talking about how to diversify the equity, the stock piece of your portfolio. And today what I want to talk about is the bond portion of your portfolio. This is considered to be the more stable, safe piece of your portfolio. And with all the craziness going on in the world right now, people are looking for ways to protect their money, right? They are getting tired of watching these markets go down every day. But the last thing that I want to happen to you is for you to get blindsided by the safe piece, the bond piece of your portfolio, because bonds in themselves could be very risky depending on the types of bonds that you own. And most people don't understand how bonds work. They could be very complicated. So all I'm going to try to do today is simplify it for you, make it so that you could actually look at your statement to see what you're invested in so you can make some decisions around that and at least feel comfortable with how your current allocation is at the moment. All right, I hope you find this one helpful. Let's get to it. All right, real quick before we get started, I am getting closer and closer to launching my educational membership group. Check it out at schoolofpersonalfinance.com. I'm going to be doing live webinars. I'm going to have pre-recorded courses. I'm going to have a community where you can come in and ask questions. We can talk to each other in there. And I'm also going to have live office hours where you could drop in on Zoom and ask me any questions. So go check it out. I would love for you to join. All right, so I think the easiest way that I could lay this out is if I go through different investment options that you might see in your 401k or your 403b plan and talk about how they work so that you can make the determination, is that what you want? Is that what you're looking for? All right, so I'm going to start with what is considered the safest option in your retirement plan or in a brokerage account, for example, and that would be a money market fund. So now I'm not talking about bank accounts like FDIC insured savings accounts at your bank or money markets at your bank or CDs at your bank. Those are the most secure things because they're FDIC insured and there's no fluctuation. You know exactly what you're getting. The interest rate might change, right, depending on what rates are doing, but you're not at risk at losing money. All right, money markets within your retirement plans or within the brokerage accounts are similar. They have a rate of return that they pay. You're not going to lose money in those. Even during the great financial crisis, people were worried about, are my money market funds going to disappear? Is the money, because it's not FDIC insured, could I lose money in those? And it didn't happen then. I don't see it happening now or anytime in the future, right? Those are pretty safe and secure. And they're usually invested in short-term treasuries and things like that. But with a money market account, you're not going to see fluctuations in your principal. What you can see are fluctuations in the rate of return. So like from a year ago, money market accounts were paying a little over 5%, where now they're paying a little bit over 4%. And all the big institutions offer them. So like, the Vanguard money market fund or Schwab or Fidelity, they all offer their own version of a money market mutual fund. And that in your retirement account, it's probably going to be the safest option that you have. You don't have to worry about losing money. The rate might change as time goes by, depending on what the environment is, but at least you know that your principal is safe and secure. All right, and then to go out a little bit further on the risk spectrum, your plan might offer a short-term bond fund. Now, this might include like 1 to 3 month or 6 month treasury bills that are under the hood of that bond fund. Now, with these bond funds, they are pretty stable because the shorter the duration, the shorter the period of time that you are locking your money up in those bonds, the less they fluctuate depending on interest rates. But you still can lose money. So with bond funds, when interest rates go up, it has an inverse relationship. So when interest rates go up, the value of the bonds go down. But when they're shorter term bonds, they don't fluctuate nearly as much as longer term bonds. And when you think about it, there's a very simple reason for this. Let's use a simple example. Let's say that interest rates are 4% and you own a 3-month bond, all right? Or you own 100 3-month bonds inside of a bond fund, right? It's a fund of all these individual bonds. And let's say the rate goes from 4% up to 6%, all right? That would be a very big jump in rates. If you own all these bonds and they're currently paying 4%, nobody wants your 4% bond, right? Nobody's going to buy your bonds from you because they could go to the marketplace and they could get 6% bonds. So in order for somebody to want to buy your bonds, you would have to offer them at a lower price to make up for the difference, that 2% that they could get just by going to the marketplace. So now if you have only 6-month bonds or a short-term bond fund where there are 3-month, 6-month bonds in there, then it's not that big of a deal because you only have to hold on to them for a short period of time and then you could reinvest in the newer higher rate bonds. So they're not going to fluctuate in price all that much if interest rates go up. And same thing on the way down, right? It's the inverse if interest rates go down. Your bond fund won't go up that much in value because those rates are going to expire when those bonds mature in 1 to 3 or 6 months or whatever the case may be. When you go out for longer term bonds, right, that's where you see big fluctuations. Because if I have a 30-year bond and interest rates go up on the 30-year from say 4 to 6%, I'm locked in for 30 years at 4%, right? I'm stuck with that. Where if I just go to the marketplace, I could go buy a 6% 30-year bond. Nobody's going to want your 4% bond. So if you wanted to sell it, the only way you're going to buy it is if you offer somebody a discount that is going to give them the equivalent of being able to earn 6%, right? So if that bond is worth $1,000, you might have to sell it for $800 in order for somebody to make up that difference in order to get that 4% where it's the equivalent of a 6% bond. So again, just high level of how bonds work. And it's a little bit confusing. You might have to listen to that over again. But once you wrap your head around it, it actually makes sense and it's pretty simple. So longer term bonds are much more volatile because you're locked in for such a long period of time. So if they go against you, then you're stuck with that bond for 30 years. Or if you want to sell it so that you can then take that money and reinvest it in something that has a higher rate of return, then whoever's buying it from you, they're going to require that you sell it to them at a discount, at a lower price. You're going to take a loss on that, or else they would never buy it from you when they could just buy it out in the marketplace at a higher rate of return, at a 6% yield. Hopefully that makes sense. All right, so next would be what's called an interim bond fund. And you could have an interim government bond fund or an interim corporate bond funds. And the only difference is that fund either invests in government bonds issued by the Treasury, or they invest in corporate bonds issued by corporations. And again, corporate bonds, they usually pay a little bit higher of a yield because they're a little bit riskier, right? A company could go out of business and then you're not getting your money back, the money that you lent them. That's what a bond is. You're lending them money and they're paying you interest on it. So now an interim bond fund is going to hold hundreds of bonds, and they're usually going to have a duration or a time frame of say 5 to 10 years or so. So now you're going out a little bit further on the yield curve, which means that the prices of your fund might fluctuate more depending on what interest rates do. So if interest rates go up, then the value of your bonds, they go down, they become less valuable for what we just talked about before. So you can lose money in an interim term bond fund, right? If interest rates, for example, go from 4 to 5%, if they go up 1 full percentage point, your bond fund could go down depending on all the individual bonds that are in there and how long the duration is of those bonds. You could see a 5% decline in your bond fund, right? So just because you hold an interim term bond fund, you can't think like this is totally safe and secure, because what if rates go up by 2%? Right? If the 10-year yield goes, I mean, it's been going up recently, right? So right now it's around 4.45 in that ballpark as of the time I'm making this video. If it goes up to 6.5%, if we see a 2% rise in the 10-year, your bond fund, your interim term bond fund could drop 10%, 12%. And that's a big hit. So if you have $100,000 in there, your $100,000, it could go down to $90,000, $88,000. You will still get interest on that bond fund, right? There's two components. There's the interest that it pays, but then there's also the principal, right? Is it going up and down, the value of the actual bonds that are inside of the fund? And then we go to a longer term bond fund. These might be bonds that are going to be 30 years, up to 30 years, 20 to 30 years. And the 30-year government bond right now is paying around 4.9%, right? So that's tempting because you say to yourself, wow, I could get an interest payment of around close to 5% per year. I like that idea. I'm going to go with that one. But the reality is, if that 30-year bond goes from 5% up to 7% or 8%, and it's a 30-year, that's a long time, right? Your bond fund is going to fluctuate tremendously. So in that long-term bond fund, in that scenario where interest rates rise 3%, you could be down 15% or more in your bond fund. And that is a tough pill to swallow. I don't know if everybody remembers 2022, that was a miserable year for everybody, especially for financial advisors, because there was nowhere to hide. So if you were managing money for people, it was a pretty crappy year trying to explain that, yes, we had money in bond funds, which is supposed to be stable and be the anchor in the portfolio when stocks are doing poorly, but the stock market was down like 22%, and bonds, depending on what type of bonds you owned in there, they were down, double digits. So it was a bad year overall for your investments. And then you might have funds that are offered that are called high yield bond funds. And typically, we used to call those a long time ago, we used to call them junk bonds. They don't call them that anymore. Now they call them high yield bonds. But the higher the yield, the riskier the investment. So if it's a high yield bond fund, then that means that it is investing in companies that have a little bit more risk to them. So you require a higher rate of return to invest in those. And those are going to fluctuate, especially if they are a long-term high yield bond fund. Those are going to fluctuate the most out of anything. So if you put all of your safe and secure money in a high yield bond fund, you might wake up one day to a big surprise thinking, wow, I thought I was being safe for this portion of my portfolio and it's down double digits. And I don't want that to happen to you. So hopefully all of this makes sense, right? As you go through the different types of bonds and the duration of the bonds that are inside of your bond fund and how they all work together. Now, just to be clear, I am not giving investment advice at all here. I'm just trying to explain how it works. I'm not suggesting that you move money out of risky assets or out of the market into money market accounts, right? That totally depends on your portfolio, your time horizon, your risk tolerance, all that good stuff. I just want you to understand what the safe part of your portfolio actually looks like. And if you want to make a decision to get safer, that you're making the right decision and that you're not putting yourself at risk when you don't even realize it. All right, everyone, that is it for this one. I hope that you found that helpful. Please leave a comment down below. Let me know that you liked it. Hit that like button. Share this video with others if you think that it will help them out. Come join my membership group. It's going to be awesome. I can't wait to get rolling with it. I will be sending out emails. If you're not on my email list, jump on my email list. I look forward to seeing you over there, and I will see you again in the next video. Thanks.